I want to bring in former Reagan economist Art Laffer to help give us his take on this. Now, Art, I should notify the audience that typically, on average, the stock market peaks 18 months after inversion. The economy peaks 22 months after an inversion. So it's not necessarily a recession around the corner. And some are saying it may not be a recession at all this time.
Well, I don't see any reason for it being a recession right now unless something in the future develops that's quite material, like a trade war or something like that. But right now, I mean, I don't see any change in policies. The tax bill's working nicely. Monetary policy's a little slow catching up. They should drop the rate a couple, 0.5% or so. I mean, if you look at all of this. But let me just say, trade issues are extremely important to the market, and the market is extremely important to the future of the economy. Just the drop we've seen from the peak to right now, Charles, is a loss in U.S. wealth of about $1.7 trillion, which is a huge amount of money, and it puts into perspective all of these arguments as to 10% on $300 billion worth of trade is. That's only $30 billion. We've lost $1.7 trillion in wealth because of, I believe, fear about the trading market and what's going on in China. So when I look at this world, I don't think we're in a recession. I don't think we're going to go into one. But if the trade thing were to come around to be good, I think we could pull out of this very quickly.
So would you say then, are you saying $30 billion justifies $1.7 trillion in losses?
Well, that's what the numbers are. An extra 10% on $300 billion in trade with China.
Right, I'm
comes
saying so
out
that's
to be $30 billion, unless I did my math wrong.
I'm saying that's is that a legitimate
the fear of the trade
correlation?
The market, I think, about $1.5 trillion.
Right, it is. I looked at the Wilshire 5000 every day, so I do the math myself. I'm saying, is that a legitimate correlation? Or should it be down that much, or is this an overreaction?
Well, I don't know. It depends on what happens in the future with the trade deal. If the trade deal comes through, it's way overreacting. If the trade deal doesn't come through and it gets into a trade war, it may be underreacting. You know, when you look at what happened during the Smoot-Hawley tariff, and I don't mean to always go back to Smoot-Hawley. I mean, the stock market fell by over 90%. If you look at what happened when I was in the White House from 1970 to 1972 under Nixon, we had the devaluation of the dollar. We had the 10% import surcharge. We had the job development credit that excluded foreign aid. We had a really protectionist administration, and the stock market fell by over 50%. So, you know, when you look at it historically, trade has a huge, huge net effect way beyond what you would expect given the size of how much trade there is. It's really very important to markets. And one of your previous guests said, well, it's been a long time for the boom to occur. That's not what causes recessions. Recessions are caused by policy actions. And they can occur in taxes, they can occur in spending, they can occur in regulations, they can occur in monetary policy, and they can occur because of trade policy. And that's the only thing that I see that we have a big issue about right now is trade with China. And, you know, I'd love to see a great free trade deal done with China. That would boost this market by well over 5,000 points.
This morning we were greeted, though, with really poor economic data out of Germany and poor economic data out of China. The so-called global recession. So that's not playing a role at all, because it seems like every time we've gotten these sort of flash numbers out of Europe or out of China, it's sent our bond yields diving lower as money continues to come from around the world pouring into our 10-year bonds, which might be skewing the historical, reference that we use. I mean, maybe this time is somewhat different because we've never been in a world, Art, with $17 trillion with a T of negative yielding rates and all these global economies going down at the same time, except America.
Yeah, let me just say that the rest of the world is in recession. They're in very bad shape, and that does impact us, Charles. You're completely correct. And we have been fighting against it because we've been doing very good policies while they have not been doing good policies. And that's why we're performing well and they are not performing well. But they are dragging us down, and they're especially dragging us down in interest rates. I mean, when you have negative real yields in the rest of the world, how can U.S. rates be way above all the rest of the world? They can't. Yeah. So we are being dragged down by them, but our relative performance is excellent.
Oh, no doubt about it.
That's because of our policies.
All right.
Our policies have made us very resilient.
All right, thank you very much. We always bring you in for your
Charles,
wisdom.
you're great. Thank you. It's my birthday today. You didn't even wish me happy birthday.
You know what? You look amazing for 38, my man. Happy birthday.
Thank you, sir. I'm going into my 80th year. Can you believe it?
You look great for real, and you're a great guest, and you always give it to us straight with experience that goes along with knowledge. Thanks, Art.
Thank you, Charles.